name is Scott Gibson with Beneath the Surface. I'm here with Keith Shaefer, the owner, publisher, and editor of Oil and Gas Investment Bulletin. Keith, thanks for being with us.
Thanks for having me, Scott.
I wanted to ask you a little bit about the last few months. You had QE3 announced not too long ago, and specifically about oil and gas, what it's done and what your expectations are going forward.
Well, the price of oil has really surprised me over the last few months. It's come up way quicker than I expected out of the June low. And so when I did my research into that, the one thing that I found that I think the whole market's been missing this is that, yes, we have lots of oil in North America, but what we don't have a lot of is refined products like driving gasoline, jet fuel, diesel, all the stuff we make from gasoline, because we export so much more of it now. And that's been the big story for why gas prices at the pump have stayed high and why oil prices have stayed high, because there is a big demand globally for these products, and we're now the cheapest export source here in North America because WTI, West Texas Intermediate, trades $15 below Brent. Everyone wants our products because they're cheaper. So that's why we really do have a global market for oil right here in North America. Everyone says, oh, well, you know, it's a captive market, but we've been exporting so much of it that we're basically now having to pay world prices. So, and on the natural gas side, we've actually seen a really interesting thing happen in the last, let's say, 3 weeks. For the last 4 to 6 months, gas has been bouncing along the bottom, but now it's been bouncing its head up against the top of that channel and it's just broken out. And so it'll be really interesting to see now what happens, because there's one industry that gets to decide gas prices right now, and that's the electricity producers in the United States. And they've really upped their usage of natural gas because it's so cheap. And of course, coal is considered a bit of a bad thing these days, so they've switched out of coal into natural gas. But now that gas is broken out, the fundamentals really favor coal again. Like, there would be a big advantage to these producers to use coal. So it'll be interesting to see over the next 2 or 3 weeks, now that gas is broken out, if they switch back to coal and this rally fades, or if it still has legs.
Interesting. Now, gold is also broken out just recently. A lot of our listeners are more on the precious metal side. What's the correlation that you've found between the gold prices and or oil and gas prices, or the relationship between the metals and the oil and gas sector?
Oil in particular is very similar to gold in that it's one of the largest derivative sources in the world. You have a lot of paper trading around that commodity, and so it's very much used, just like gold, as a hedge on the US dollar. So when you get these quantitative easings happening, you saw it with QE2 and you're seeing it now with QE3, where the price is moving up in anticipation of a lot more liquidity in the market, devaluing the US currency. Therefore, because oil is valued in the US dollar, it has to rise when you have so many more dollars in circulation. So not to the same degree as gold, but still in the same vein.
Nice. Now, your publication talks about what you're doing with your money, what particular companies, specifically junior oil and gas companies, you're liking right now. What can you share with our audience of the type of thing you're doing and the kind of companies that you like right now?
I'd say the thing that I'm looking for the most right now is you're looking for one of these new big resource plays, the shale plays, the tight oil plays that have just fantastic consistency over a large area. Your mining watchers will think of potash that have in Saskatchewan, where those formations spread for miles, tens of miles. And these shale plays are a little bit similar to that. Not quite as big or quite as consistent, but still, once you've found one, your hit ratio goes to 95%. So that's just fantastic when you know that once you've found something, you've got the next 5 years of drilling. So one of the plays that I'm quite excited about is a company called D3, DTX on the Toronto Stock Exchange. They've found 2 of these formations. They've found, and still very early stages, so there's a lot of running room left, literally hundreds of drilling locations, several years worth of inventory for drilling. So a lot of long-term, low-risk growth already baked into the cake.
And in terms of disclosure, your publication talks about the companies you own, so you obviously own that one?
Yes.
I do not own that one. Thanks very much for being with us, Keith. Love talking with you about oil and gas and your expectations of what's to come.
Thanks, Scott.
Again, my name is Scott Gibson with Beneath the Surface. Thanks for being with us.